Hey, and welcome back to my YouTube channel. Today I'm going to show you my own real estate property analysis sheet and how you can run the numbers on any property you like. I'm even giving you the sheet to use. Stay tuned. Hey everybody, it's Jeff Thibodeau here with Redline Properties. Welcome back to my YouTube channel. I'm a real estate investor, also a real estate broker for over 12 years, and I own a company here in Brantford, Ontario, Canada. We're the largest independent real estate brand in our city. Every day, every week, I'm running analysis on the market and helping my clients understand the opportunities they can take. And today what I'm going to show you is probably, I'd say it's the biggest question that most beginner investors have of us, is really understanding the fundamental math behind purchasing a cash flowing rental property. Probably one of the smartest decisions you can make is to at least own one other property other than your primary residence that's also growing and making you money. So today I'm going to walk you through a simple exercise to analyze the numbers of any property. Doesn't matter where you live, what the price points are, and I've actually linked in the Google Sheet I'm going to use. You can click on it, you can play with it, you can download and make your own copy, and you can run this analysis for yourself. So let's get right into it. But before we do start, if you're new here, it would really help me out if you go ahead and hit the like button. Let me know that you're enjoying this content, and then go ahead and hit subscribe, turn your notifications on so that you get this content delivered to you, and it really helps me know that you're enjoying the content and that I should be making more. So before we get going too much further, let's hop right into the sheet and start analyzing a typical property. Now, what you've got here in the sheet is a Google Sheet that I've made up specifically for you. The one I use is a little more complicated, it's a little more colorful and branded, but this has got everything you need to do these calculations. And I'm actually going to show you how you don't even need this Google Sheet. You could be doing these exactly on hand. So what I've got here, I'm actually just going to erase out all the information from the last analysis I was running. And that's basically all these gray boxes. All the gray boxes I put here to fill in, and all the white boxes, we let the spreadsheet do its work and give us some answers. So when it comes to analyzing a rental property, there's kind of four big sections we need to look at. So the very first one that I like to analyze is the cash to close, because this one's really important to know how much actual physical cash or secondary source of cash you're going to need on closing day. So what we do here is we put in the purchase price, and for this property I'm going to use an example of something that's affordable and available in my marketplace. So I'm going to, for this, use a detached house that we can get for around $350,000. Okay, and I know what you're saying. If this isn't available, if that number's too big in your market, or you can't buy anything for $350,000, don't get caught up on the exact number. You can plug in whatever's available in your market, or you might look in other markets where there's more affordable properties. You don't necessarily have to buy in the city you live in if you can't afford or the numbers don't make sense. But then in here, I'm going to put in a down payment. And on a typical investment property, unless you're doing something funny, here in Ontario, we're looking at a 20% down payment. So let's assume that on this property. But again, whatever you're going to do for a down payment that's allowable in your market, you'd want to fill those numbers in here. For agency fees, depending on how you're acquiring this property, typically I'm going to have zero on the buyer side here, but if you had to pay a fee to acquire this property, if you had someone helping you out and that fee wasn't being covered by the seller, so we'd put that in there. And then depending on how deals close in your marketplace here in Ontario, you got to hire a lawyer. That's going to cost you somewhere $1,000 or $1,500. I'll put it in here for let's say $1,200 to get the deal done. And the next little expense we're going to have right off of day one is what we call land transfer tax. You might have something similar in your state or province. I included here for Ontario a little calculator you can go use, but let's just assume this is the exact number here, but you've figured it out and we've got it put into the chart. So these costs are all kind of starting to add up. We want to start to think about what we have to do to the house before it becomes a cash flowing asset. These next two columns, right? We've got renovations and repairs. And people ask, well, what's the difference? To me, I have two columns because I like to think as repairs are things that I got to spend money on, but they're not really changing the value of the house. Just some simple fix-ups, some simple changes. But if I called out an appraiser to reappraise the house, I'm not going to see my money back. It's just a little bit of cash I need to put into the house. Versus a renovation, for me is something that is improving the value of the house. So I'm actually investing more capital into the house to make it go up in value, at least that amount or if not more. So let's assume on this property, I need maybe some new flooring, do a backsplash, just make it a little nicer. And I've got about $5,500 worth of potential repairs, or sorry, renovations I need to do. And other than that, no real immediate repairs. And I'm not too worried about a contingency fund. Contingency fund might be if you plan on, say, not having it rented for the first 6 months, you might need to account for the fact that you're not going to have any rent right off the bat. So what this does then is it's going to add up all of these numbers except the purchase price, and it's going to give you that total cash needed. So one way or another, you're going to have to show up with $80,425 to buy this house. Now, that doesn't tell us whether it's a good or bad investment yet. That just gives us a number. Now, I know what you're thinking, Jeff, what if I don't have $80,000? And yeah, that's like most of us, right? Getting started in real estate investing, buying the first property is always the hardest one. Now, there's a lot of ways that you can find this $80,000 or make it work through a secondary loan, potentially home equity in your home, or you've done a good job doing a flip. There's lots of different ways. So don't get caught up on that. If you need help figuring out how do we get the money together to buy your first investment, just drop me a comment or send me a direct message and we can start talking about that for you. But for now, let's just look at this number as the amount of cash we would need to show up on day one, and the rest of the money is going to be covered by a mortgage, okay? So that's section number 2 for us. Section number 2 is with debt servicing. So if you're not buying this 100% cash, we're only bringing $70,000 cash in, then we're going to have to get the other $280,000 from somebody else, a mortgagee, and we're going to have to make a monthly payment with interest. Now, I have added one more column here for mortgage insurance in Ontario. Across Canada, if you're making a lower down payment, you may be forced to make an insurance premium fee. Here with 20% down, we're going to say that fee is $0. And then you need to go ahead and fill in the terms and the payment of your mortgage. Now, this is going to be very different depending on who you're borrowing from, what you qualify for, what the rates are when you're watching this video. But I have included a little mortgage calculator here that you can click on, and it can head over here and give you a good idea of the different rates available currently and how those would turn into payments. I've also given you the land transfer tax calculator here too. And these are from our friends over at RateHub, providing these tools free on their website. So once you've figured that out, you want to type in the rates that are available for you. So if I was buying this property today, I looks like I'd qualify for a 2.99. That'd be a 5-year term, but the mortgage being paid off over 25 years. And that's just for information. That's not making anything happen in the chart. But what that mortgage calculator would tell us on the other page is that I need to repay $1,324 every single month. So that becomes my debt service. Okay, we're halfway through the equation. Now we've kind of figured out what we need the cash to be there, the mortgage, and what that mortgage is going to cost us every single month, and all the different closing costs involved in buying this property. So we've kind of gotten ourselves to, day of possession, but now we want to look at, well, how is this going to perform as an investment? And really we're looking at different numbers now. Now we have to look at the income and the expenses that this property generates. So on the rental income, let's say that we're buying this house, a similar one we've done recently here in Brantford, that we were able to get $1,600 for the main upper unit. And there actually is an accessory 1-bedroom apartment, a legal unit in the basement that gets us another $800. So we have a total of $2,400 of rent, and potentially we've got an extra little $50 hiding around here, we'll say, comes in from us having a little detached garage that we don't rent to the tenants, we actually rent to the next door neighbor. So finding little creative ways to generate more cash flow for your property is one of the ways you can make it a better investment. So in here, we've been able to have 2 units in a single family home and also rent the storage shed out to a neighboring property, kind of maximize the amount of revenue it's gonna generate. You could also potentially have laundry facilities, you could charge for parking, you could rent your roof to a cell phone tower, you could have a billboard on the side of the building. There's all kinds of ways we can generate more revenue from a property, so feel free to add them in. But what we want to figure out is what is the total monthly revenue, and for this property, it's given us $2,424. Now we have to look at what the monthly expenses are. Now our property taxes, we're going to pay them annually, but we want to just break them down for this analysis into monthly expenses. So on this property, that'd be $182 a month. We're going to have to hold insurance as the landlord. The tenant also should have insurance for the contents, but we're going to insure the building. And so that's here in our market going to cost us around $65 a month. The tenant is going to cover all their own utilities and expenses. And then I like to have a few columns here for vacancy, reserve fund. These are our little safety nets. And so it's just to build into the equation to make sure that we're not on razor thin edges here. So, you know, assuming every month I put aside an extra $72 just in case I have a rent-free month sometime in the future, and also in case a little unexpected surprise. And so these are good to build into your equation, some percentage vacancy rate and reserve fund, and then potentially you may have a condo or HOA fee. Here we don't. So I have a total of $391 of expenses on this property with $2,450 rent. That sounds pretty good, right? That's like over $2,000 a month of profit. However, we've still got to pay that mortgage back, right? So this is where our calculations start to come into place down here in the bottom side of the screen. Is the number one thing now that we have all this information is we can now perform some cash flow analysis. So what we want to look at here is the first column that comes up is our total income. So that's just bringing this number down from up here. Then we're bringing in our total monthly expenses. That's just bringing this number in from over here. And then we're bringing in our total debt service, which again is just bringing this number from up here down here. So if we have income minus expenses minus debt service, then we find ourselves with our monthly cash flow. And if we multiply that by 12, we're going to find ourselves with our annual cash flow. So pretty good. If this property all works out how our numbers say it's going to work out, we're going to find ourselves with $735 a month of additional free cash coming in. And on a year, that's going to mean this property generates $8,820. Now that sounds like pretty good numbers. So let's change things up a bit. Let's say things don't go as well. Let's say potentially, you know, we're only able to rent the basement for $600 and the upper for $1,700. And the guy with the storage shed never ends up paying us. Well, now these numbers have dropped, and that's automatically brought them over here, and now our cash flow is only $585. So you can see immediately how this equation, if you change the numbers, you're going to see that's effect on your cash flow. Now, the question everyone's going to ask is what's a good or what's a bad cash flow? And that's completely up to you as the investor. Some investors are very heavily cash flow focused, meaning you want to see a large number in there. It's becoming part of your income. Maybe it is your income. You don't have a day job and your revenue is coming from being a landlord. And other people may want to keep their cash flow as little as possible and have a higher mortgage payment and other expenses on the property to minimize taxes. So there is no perfect answer, but we need to know is what are your cash flow needs, and then judging, does this property match your cash flow needs as an investor? So that's the first thing we look at. Another question here that people ask is, what about negative cash flow? What if a property isn't making money every month? And again, that's a decision as an investor. That doesn't mean it's a bad investment, because the property may be appreciating. The value of the house may be going up so much faster, then you don't have to worry necessarily if it's costing you a few $100s a month. Remember, if you're putting money into savings anyways, that's a negative cash flow investment. You're putting your money out into savings. Well, same if you buy a house and it costs you an extra $200 a month because the rents don't cover it, but that house is still growing in value, that's still a smart investment. But again, it all comes down to your specific goals as an investor, and that'd be the first thing we would talk about if we were working together. The other thing here that to look at is something a lot of residential investors don't look at as much, but we call this the cap rate. So the cap rate is a different way of calculating things. It pulls out the debt service. So the cap rate tries to look at all investment products as equal, because it doesn't know the difference between what mortgage you or I are going to get or what rate. So it purely looks at the value of the income minus the expenses to give us our cash flow without paying the mortgage down. And then we're looking, how does that relate to the price we're asking to pay? So that gives us our capitalization rate. And these numbers are really good to calculate because it helps you compare different properties against each other. And you also start to learn what a normal capitalization rate inside your market is, and you start to be suspicious of anybody who's selling a property for a much higher or much lower cap rate. But stay tuned, we'll do a whole nother video on cap rates. Becomes a lot more interesting in multifamily homes and commercial industrial investment. But just so you know, we were looking at a total cash flow of $22,000, almost $23,000 on a purchase price of $350,000, and that division is what gets us the cap rate. The last little number that investors like to look at is called the cash on cash return, and that's an effect of how much cash do we got to bring to the table, and then how much revenue does that generate. The beautiful thing about an investment like this is with only a 20% down payment instead of 100% down payment, we're able to acquire a $350,000 property for only $80,425 out of pocket. Now, if we take the cash flow, the true cash flow generated, and we divide it by the real cash that we put out to make this investment, now we get a number, this one particularly at 8.37%, that we can compare this against investing our money other ways, compared to how can we invest our money in the stock market or somewhere else. And this way it can make us decide whether it's worth it to go after a real estate investment based on this type of cash on cash return. Okay guys, so these are the three main little areas, these analysis that we're looking at for a rental property. But what we want to check next, outside of this on a different video, is looking at then the market and the rent appreciation. So basically what this will tell us is that all things being equal, if we buy this property and we hit the rents, and with the expenses stay how we projected, this is how it's going to roll out. But a few things this doesn't account for is, number one, markets appreciating and depreciating. So your net asset might be going up in value month after month after month, and you'll be able to recover a lot of that appreciation. Number two is you may be able to increase your rents yearly, or potentially if you change over tenants and improve the property, be able to get new higher market rents. And of course, your expenses may also increase. So we want to build these things into a more robust model. But what I've given you here today, guys, is a very straightforward, quick to use spreadsheet that you can click and download, use yourself, play around with, and start running some numbers. Because if the more you know about how these numbers work and how income and expenses and debt service all affect your cash flow, you'll be well on your way to finding that next great investment. So if you made it this far in the video, thank you very much. This next video up here on the screen is the one that YouTube thinks that you're gonna like the most. So go ahead and check that one out. And if you haven't subscribed already, hit my little face over here and let me know you enjoyed the video by subscribing and getting all of our new videos sent directly onto your homepage. Thank you very much, and I hope you found this video useful. Please leave me a comment, and I'll talk to you very soon.